Hey, welcome to the closing beat, everybody. Happy Thursday to you. How you doing out there? Good? Yeah? All right. That's good to hear. We are financial advisors here at Jazz Wealth. While other advisors are playing checkers, we are playing chess. One great example of that is, what about the other stuff in your life? Like retirement's like usually here for somebody. What about the other stuff? How can we control the you so that we make sure you don't go off the reservation and you can achieve all the other wealth goals and things? Well, one of those things we're going to be talking about tonight in Wine and Wealth is donor advised funds for those of you that are charitably inclined, but also for those of you that go, wait a minute, there must be a trick. I need to know how the rich people do this. We're going to go through it all. And of course, as always, we don't sell anything here at Jazz Wealth. So it is purely just a fiduciary discussion. Grab a glass of wine, come get a little loose with us tonight. We will talk about how the rich people use donor advised funds. Why? I mean, yeah, they like to give to charity, but like, why do we do it? What's the advantage there for us and to make us feel good as well? All right, stock market. We're going to get right into it here today because we've got a few things to cover. I'd like to point out, I'm going to start. I got to just go right over here. Just look at the Russell. You guys see the small caps today just blasting back over these year-long highs there? That's up 6% in just 2 days there. And I'd like to point out, it's a broad rally too. That's the biggest, satisfying part of this rally in small caps, mid caps, and, the S&P as well. Since the October low, which is down here, right, where all the entire market's all pulled back, all the indices pulled back. But since that low, it is the best performing index now. By far, actually. So really, really good there. It gets a boost, obviously, from Mr. Jerome Powell. Why? What's the lesson there? Why are people rushing into this all of a sudden? And they were already, but why is it just sort of blown off the top here and taken off? Well, remember that the small cap stocks are more interest rate sensitive. And we don't need low rates for small caps to do well. We need predictable rates, right? Small caps are in that phase where they're, borrowing is a really important part of what they do. And if they can, sort of quantify the amount that they're going to pay to borrow over the course of a year, 2 years, or whatever, okay, now we can figure out how that affects their earnings, right? High interest rates, of course, don't help anybody, but, we're not technically high if you think about it. So we don't need low rates, we need stable, understandable rates. And so when you look around the market today and you go, well, what's going on? Right? Everything that's interest rate sensitive is where people are rushing into. And again, it's not because the cost to borrow is going down. That's certainly helpful. It's because now we have a clear indication from the Fed of what the cost to borrow might be. Right? And so and even on a personal level too, if you're curious, I mean, that certainly helps you. You probably are at least slightly more optimistic than you were. So certainly helpful there. Across the board, Russell 2000, small cap value, growth, small cap index, doesn't matter where you look, whatever factor you look at, an amazing, amazing move there. Now, here's the trouble. That's a little too far, too fast. Okay. Indices, stocks, commodities, you name it, alternatives, the pricing of those, even bonds, they don't like to go too far too fast. You can look back at every single example where anything in life has underpriced itself too fast or overpriced itself too fast. So I worry that, I wouldn't look at this and say, we're going to get another 6% in just 2 days. I think you have to assume who wants to be in is already in, and now we just get back to hopefully a little bit more normal pace there, because that's an incredible pace. All right, you go to the S&P here. We are now comfortably at new all-time highs on a total return basis. Total return. Tonight on Jazz After Dark, we're going to talk about total return. I'm going to give you one specific example of something I promise basically every one of you are probably doing right now. We're going to talk about the total return because often we look at returns and think, I want that. I want my money to grow. Of course, we all want that. What is the total return is what's more interesting when it comes to the amount that you get to keep. All right, so we're going to go over an exact example here tonight on Jazz After Dark. Now, with the S&P, it's not the rally that's interesting so much as how the rally's happening. It is, again, it's a broad rally. Again today, we didn't have a lot or all of the top 7, the big guys out there. We didn't have them participating. It was almost everybody else, okay? And over the past couple days, actually, what we've seen is the average stock in the S&P is above the blue line, the 50-day moving average. It's kind of an indication of like short to midterm progress for a stock. We just plop it there just as a visual cue. And so we now have, basically, we almost have 90% of all stocks in the S&P 500 above the 50-day. Okay, so that shows participation. It shows that what we've been complaining about all year is that these 7 names are doing all the heavy lifting. Well, now everybody else is saying, we got you. We'll take over and help you out there. And oh, by the way, that's with energy being, been kind of weak. Energy's been the weak link. It's still the weakest sector. Year to date, energy is not the weakest sector, but over the last like little pullback here we've seen in oil, was that over the last like 3 months or so, energy's down 7%. Right? So even with that, we still have over 90% of the S&P stocks over their 50-day moving average. Now, another thing, I saw the comment the other day. I replied to it, but saw the comment where somebody said, well, now the S&P is well above its average. So what about that average now? What do we do? And I don't think it was criticism or anything because I can't control the averages, but it was cool because you go, yeah, right, that's a good question. Now that the S&P has clearly outperformed what it normally does in the first half of the year, in the first half of the month, and given the fact that we've seen a very average market throughout the year, is this an outlier? Do we look at this now and say, full steam ahead, just go ahead, pile every single dollar you have into the market now? I think, like I mentioned in the comment there, I think you approach this with a hint of skepticism. Because every time this year, at least, the market has done something above average and reverted to the mean. It's done something well below the average and reverted to the mean. The October pullback was a great example. So we now have, in just this little month, it's a really short time period, I get it, but in just this month, we have far outpaced what we normally do in the month of December. We normally can see, by the end of the December, average gains about 1.5%. We're at 3 right now. Tomorrow's the halfway point, right? So do we look at this and say, yes, full steam ahead, or do we say, I betcha there's an opportunity for a pullback? I'll bet you the stock market does not replicate what it's done in the past 5 days over the next 5 days. That, I think, is where you kind of look in there and say, well, that's a little too far, too fast this bit. Let's just be careful here. Let's not go gangbusters. It's not going to be a 20% month or anything like that. I think that's how you have to approach it. All right, sector-wise in the S&P here, since this low, the October low there, the real estate sector is the best performing sector with a 20+% rally there. Money is going into the rate-sensitive areas real quick. Does that mean you do that? You might have already done it. I don't know. But it means that money is just committed now to this sector. So why do we have to be the first person to jump all over this? Why do we have to pay well above average prices in order to participate? Could we not just take a minute, and just sit back, sit on our hands a little bit and say, okay, I get it. You guys got excited. Nothing's going to change in the interest rate world. So yeah, maybe that ultimately was the bottom, but can we let it pull back? That's how I kind of feel about that. Now, if this were a news-driven event like Congress is going to vote on something, right? And we'll know by next Friday whether they pass it or not. And we got some rumor today that, it's going to go through, right? Okay, I could see a move like that. But there's still the event that is going to decide whether this happens or not. We now know that we're in an interest rate environment that should be stable for a while. And technically a little bit off of the rates that we've seen. Okay, that's fine. That's I'm happy about that. But because of that, what's the rush? It's not like they're going to make a decision next week, the week after, whatever. No, we can take a break here. We can let this just kind of do its thing, So be wary of that because it's real easy to watch a sector go up and think, I missed it. Oh, patience. Get your price. Get your comfortable buying level. I don't know what that is for you, whatever. I can't tell you where to do that buying, but why pay up here? That's like the car craze. Remember the car prices, they went crazy. Did you need a car? Why were you chasing it, right? Give it a break, like a little bit. Let's see some inventory there stuff. All right, anyways, moving on. I'd like to talk about the Dow here real quick, and I got a quiz question for you. So the Dow closes above 37,000 yesterday. That was a big deal. Did you see that everywhere? Everybody was talking about, that's a First time we've ever closed above 37,000. What is it about 37,000? What is it? Why is that even interesting? Why are we, it's that everywhere. Like, we talk about the S&P hitting all-time highs on a total return basis. We talk about the Russell just abnormally blasting off. But no, we're focused on the Dow here. That's what everybody was talking about. And the reason for this is because 37,000, of course, is an all-time high. It's the first time we've ever done that sort of thing there. But it's taken over 2 years to get the Dow to go from 36,000 to 37,000, to cross it, right? It's taken over 2 years. It's only a 3% move, right? It's kind of why it's a big deal. It's a reason to celebrate. It's, all right, that's cool, right? Of course, it's been lower and it's fallen in there, but to go from when it last hit 36 to now hitting 37, 2 freaking years there. I'll give you an example. We went from, where is it? We went from 14,000 to 15,000, and it took 6 years. And that's about a 6.5% move from to add 1,000 points to 14,000 to get to 15,000, about 6.5%, right? So it took over 6 years. So that's kind of impressive, right? 2 years to jump 1,000 points. It took like 40 years to go from 0, or when it started, to 1,000. Granted, that's a huge jump, but you know what I'm saying there. So the quiz question, I'm sorry, it took 57 years, just hit me. 57 years for the Dow to go from 0 to 1,000 on a percentage basis. Obviously, that's a massive move, a quadruple digit move. I get all of that there. But here's your quiz question. What is the fastest, and I won't sit around and wait for the stream to catch up or anything. What is the fastest that the Dow has ever gone from 1,000 marker to the next 1,000, or whether it was from 14 to 15, I gave that one away there, took just over 6 years, 15 to 16, 16 to 17. What is the fastest number or amount of time that it has taken for that to happen? Let's see who has the best guess there, because it's pretty shocking. All right, let's move on here while we let stream catch up. So interest rates moving lower again. Remember, as interest rates go down, the price of bonds goes up. That's good for your bond funds. That's good for anything that you've been participating there. Of course, you're happy to see that. The 10-year, I'm on that anyways. So the 10-year broke below 4%. It's just psychological, right? There's nothing else to say about it. Where are we at? We got down to 3.921. I don't have anything interesting to offer to that other than that being psychological. The 2-year is a little more interesting to me. The 2-year Treasury has now retreated itself on a yield basis, has retreated itself all the way back to where it started the year. After all that, it's just basically flat, like nothing happened. Almost, very, very close there. So I thought that was kind of interesting. What do we got here? 30 to 31,000. Yeah, but how long? Fast Eddie says 1 month. Okay. Okay, no right answers just yet, but you guys keep going. In the meantime, I'll move on to some of the stocks in the news. I will give you the answer. Just someone don't let me forget. Let's see if anybody gets a good guess in there. Honest answers. We go searching around now. All right, stocks in the news. Occidental Petroleum, you got Berkshire Hathaway increasing their position there. I think it was $600 million. Something like that, right? So that was the talk of the news there. Not much more to read into it. Toll Brothers, following they saw the chart. They know the drill. Remember, I shared the chart with you. We could probably pull it up pretty quick again. They know what to do with their money given where the economic cycle is. If I were running a public company, I would know better than to go against what investors want at the time the economy is in that cycle. I can't say any more words to continue to stall. There it is. Slide 115. That's how far I had to go. Look, we're now right about here. Investors want to see you do what in a from a peak to a trough type environment there. We want to see return cash to shareholders. You do that, you get rewarded. This is one of many who have decided, you know what, let's buy back some shares. They're buying back 20 million shares, and don't just say, 20 million doesn't sound like a lot. That is 1/5 of their entire valuation. They're spending that kind of money. You spend that kind of money to buy back your shares, look at you get rewarded. And add to that, it was a good day as well. But All right, Nucor actually lowering their guidance going forward there. They're saying pricing is an issue there. Pricing the prices they pay, not the prices that they send to their client or customers there. So interesting there. Oh, sorry, typed it wrong. Seadrill in the oil and gas space there, they are also doing a buyback. What happens? You do a buyback, you get rewarded. They're doing $250 million worth of shares. That's about 8% of their total market cap. Buy back your shares, right? Let's just all reference the chart. Yep, that'll do it. People like that, right? That's one of the fun things to look at. Adobe, here you go. Adobe themselves, the beat on earnings and everything, they have some issues with, so they're spending a lot of money putting AI into the products that they have. You know, Photoshop, they've already done that, Premiere and things like that. So they're having an issue with the cost to do that relative to the number of new subscribers that they get. It's a subscription service. And that'll work itself out, but for the moment, that was a bit of the offsetting play today. And lastly, I've never, ever, ever seen this before. I think it's a good thing, but I can't tell you. I'm not allowed to say like, oh, buy the stock. Pfizer. Pfizer comes out with essentially lowering their guidance. They did it in a really unique way, and I've never seen this. They basically told you we're lowering the bar beyond what we think it will be. In other words, we will beat these expectations. If you read closely what they're saying, we will beat these expectations, but we're going to lower the bar really far now because what have we got to lose? Right? It's kind of brilliant. So basically, they told you exactly why this was going to happen and exactly what they're going to do. They said our COVID revenue, instead of it being 12 billion, it was kind of estimated out there, we're going to make it 8 billion, although we'll probably do 9, right? Their words, not my words. They said that. They said they're on track to do the same amount of revenue in vaccinations, but we're going to leave some wiggle room there just in case. Not just to the downside. They say the virus could get bigger. Something could happen. More people could get the vaccine. Who knows what happens? But they're telling you that at this price, our best play is to lower the bar so far that you'll forget all about this. And by the time we get to earnings, we go, ha ha, look at us, right? Look how well we did. What's that tell you? What's that tell you? Just saying. Tomorrow, we have really no earnings. Darden Restaurants will be the only one, if I remember correctly. And what is the fastest that the Dow has ever gone from one whole thousand number to another thousand number? We've got 2 years as a guess, 3 months. There you go. Okay, that's a decent question there. Lucas says 2 days. What 2 days would that have been? Where? That would be, that 2 days would just be blast up. Although Lucas is officially the closest without going over. The record for how fast the Dow has gone from a 1,000 point increment to another, 5 days. And that was during COVID. How could that be, right? Remember, the stock market's biggest gains come in the wildest and scariest of times. 5 days during COVID, when we hit that low, we rallied 1,000 points in 5 days there. And remember, that's not a rally of 1,000 points. That's from 1,000 point marker to the next. In other words, if we crossed it, the clock starts, right? So I'm not cheating there. Yeah. Pfizer reminds you of the old GE. All right. Gotcha. It's kind of different. But, all right, let's see what questions you have. If you have any questions, otherwise I'm going to get ready for our Wine and Wealth here tonight. Remember, Jazz After Dark tonight. We're going to talk about how you're sort of looking at your returns in the rookie or novice kind of way. We're going to break it down a little bit more. I will give you an exact example as well. Yeah. Did somebody else get it? COVID? No. Wait a minute. The COVID doesn't count. I say how many, what was the length of time? Or need the event. You don't get that one. I'm sorry, you can't have that one. JA says, what metrics should we look at for financial data / stock exchanges? That's an interesting question. You want to know about the fundamental like financials of the actual exchanges. If that's the case, then really the NASDAQ or the CME would be the way to look there, or the CBOE. You can do that. Those are public. So you can actually look at their fundamentals easier. That's it. Just pretend it's a company. That's really all they are. But you just look directly at the source. Just no different than me looking up Pfizer and seeing what's going on. You can even go directly to their website and look at their earnings reports there. The transcripts are there as well. You don't have to get crazy and, buy stuff and whatever. Defense contractor stocks fall today. Why was that? The deal. Are they going to get money? Are we going to send, what was it, 61 billion to Ukraine? By the way, how'd we come up with 61 or 66 or whatever it was? Where's the money going? Anybody want to know that? Like, I'm a numbers guy. I don't care if it's Republicans, Democrats, or whatever. Every time they come up with one of these numbers, I'm like, can I see the breakdown of where this money's going to go? Where is that? I looked. I can't find it. There's nothing. But that's the reason. Such people start to get ready to buy bonds, or at least stand by to invest in bonds. Oh, I can imagine people would be interested in pullbacks in the bond market, because think about what just happened. The Fed sort of set the floor price-wise. So any pullback towards that price, we know, is met with an over-assumption of what rates will be in the next year. That's why you probably won't see that happen, right? Because everybody and their mother would go, what? That's like negative oil. That we're actually on video. The day that oil went negative, me and Cody were live, and we're like, you seeing this? It was like, who wouldn't buy oil at a negative price? Of course, slap the button as much as you can. Love it. Yeah, I love it. Oh, a little bit late today. It's okay. Forgive you. Shopify, looking at the peak in Shopify. Check this out. All right. Set up. Okay. So think of this is a dangerous thing, right? If you take a new move and on that first day of the new move, assume that's the end of the new move, you will be wrong more than you will be right. Traditionally, and from a technical standpoint, the peaks in a stock or an index or whatever it is come after multiple days of movements, or weeks even. You can look here, right? We have a multiple day movement, both up and down. Same thing, up, we got a multiple day movement, big explosion, and then it peaks out there. In the short term, of course, because I'm just using a daily chart here. It's the same on the downside, right here. If you said that this first day of this new move down was the bottom, just taking the inverse of what you said, you technically were right, just not right away, right? So this new move here, we've obviously consolidated right near the 20-period moving average, all that stuff. It's had time to digest this big old move that it's just had. Why we now have this new excitement? Why would it stop there? That's a fresh round of people that are interested. Yeah. Solar Edge as well. Yeah, solar, anything. Remember, those are interest rate sensitive as well. The stocks like Solar Edge and Enphase and stuff, the Fed just essentially said, we got you. You know what I mean? That's not my opinion. I'm just saying that those stocks were being beaten down because their interest rates, their cost to borrow, which they need to borrow a lot, is just going out of control. It's like a runaway train. All of a sudden, we're getting clarity that it's no longer going to be a runaway train. Might still have an impact on their earnings. They're still maybe not out of the clear, but you now have a reason do you see why people are just going and buying the devil out of that thing? It's because they're like, great. It's exactly like a lawsuit. Oh, the EU is filing $1 trillion lawsuit against Alphabet, right? And then they settle for like $2 billion, okay? Well, during that, we go, oh, it's $1 trillion or some crazy number. We don't know how to quantify that into their financials. What if they actually have to pay some large percentage of that? That could be a big deal. But as soon as you know it's $2 billion, notice how stock goes up? You go, $2 billion, and the stock went up. Yeah, because it's a number we can figure out. We can now apply that as a one-time charge against their earnings and go, stock's valued here. So it's the same concept there with interest rates. Yeah. All right. Jazz After Dark tonight. as well as Wine and Wealth. I'm going to try it a little bit early here today for Wine and Wealth. Hope you'll come check us out. If you're one of our clients, it will be in the portal. It will show up that we're going live, and most people watch the replay. It will be there and archived forever and ever and ever. You guys enjoy the rest of your evening. I've got to go get working on this here, and enjoy your hopefully not stormy weekend.